Good evening. Yes, good evening, Aju. Good evening,
Evening,
Sima. Good evening,
uh,
everyone.
Good evening, sir.
Good evening, Christine.
Good evening, sir.
Good evening,
Sir.
everyone. Happy evening, Pushpawali. Good evening, Anugraha. Let everyone join in. We'll just give you a minute more. Then we'll start off with today's mentoring program. All right. Yes, I think I'm live on YouTube also. So I'll just share the YouTube link with everyone. I hope I'm live. Good evening. Wait, I'm not able to get the YouTube link here. Yes. All right, I got the link. I have shared the YouTube link in the WhatsApp group also. I hope you're all doing good. How is your studies going on?
Going well, sir.
Going well, fantastic. We are now almost at the end of February. We have one more month in which we have to complete our entire AFM syllabus. Am I right? Yes, we are on 24th February. So friends, I'll just start off now. Good evening, everyone. Very happy to see you all over here live. Wait, I'm just spotlighting myself. Yes. So as I have already told, we are here with the objective of finishing our complete AFM syllabus by March 31st, April 1st to April 10th. We will have 3 examinations, 3 mock exams, 3 MCQ. So by April 10th, you are all ready with the entire topics. So friends, right now I'll start off first with the study plan. I'll just open and take the study plan now. So we are done with 3 topics by now. One, we are done with security evaluation. 2, we are done with portfolio. And this week, we were doing which one? We were doing derivatives, that is futures, options, and interest rate derivatives. Am I right? So I'll just take the study plan now. I think the study plan is available over here. Wait. Theory marathon mastery book. What happened to the study plan? One moment. Everyone, please mute yourself. Yes, 2025 mentoring. One moment. Yes. So friends, as per our plan, first week, February 3rd to 7th, we focused on security analysis, security evaluation, and securitization. Am I right? Then second week, we went to this topic of portfolio management. Now we are in week 3 where you're doing what? You're doing derivatives. Am I right? So friends, when I go through the assignment part, I just want to show you that also. You should know how everyone is faring in the assignments right now. If I take assignments and if I take portfolio, right now, if you check the status, I have around 75 plus 11, 86 people have submitted the portfolio assignment. Hats off to all of you. I think I'll just show their names quickly over here for everyone to see them. Great job. Keep it up. Others, many of you might have joined the mentoring program late. Whatever be it, you still have time. Just that with the existing 2 hours, it might not get over. Give it some extra time so that you can complete your entire assignment. So hats off, Abdul Kader, Ajuad, Akshaya, Alina, Alvin. I'm scrolling down the name. There are a lot of names here. Great job. Keep it up, friends. Keep up. I think I've put the screenshot in the WhatsApp, in your WhatsApp group of all these people who have done the assignment. Friends, when you do these assignments, understand that you're one step closer to your results, one step closer to your becoming a chartered accountant. So please, please, please don't compromise on the assignments. Right now, if you haven't done it, absolutely no issues. You still have time. You can do it and complete everything by March 31st. But please keep that March 31st as a non-negotiable point. Whatever happens, do not let your deadline go beyond March 31st. Is everybody clear with this part? Right? So today we are here to discuss and clear all your doubts, mainly on portfolio and security valuation. And then this week we have provided you with futures, options, and interest rate derivatives. Since that started just now, I am not doing a concept revision of that part now. Because if I do that, it might become too early for me to revise those topics with all of you, because many of you might be just studying that. So today, my discussion will be mainly on your doubt clarification. So whatever doubts you have, friends, please ask me so that I can clarify all your doubts and we can take it forward. Okay? Yes. So the dais is open. Please interact with me and ask me whatever doubts you have in the topics of either security valuation or portfolio management or futures, options, interest rate derivatives. Yes. Sridevi, good evening. Do you have a doubt?
Yes, sir.
Wait, you're not audible. 1 minute, you're not audible. Can you please check your mic?
Yes, sir. Am I audible now?
It's better now. Yes, yes, yes. Please speak, Sridevi. Tell me, what is your doubt?
Sir, I have a doubt in portfolio management overall proxy beta.
Okay.
Question number 6 in ODB book.
1 minute, I'll just take the question. Question number 6 in the ODB book, is it? 1 minute.
Yes.
This one, right? Yeah. This one, correct? Okay, tell me.
Sir, I wanted to understand how we got the ratio, like E divided by E plus D into 1 minus T. I'm not getting 4 by 4.6, so I just wanted to understand.
1 minute. You were not getting 4 by 4.6, is it? Okay, that part is your doubt, is it? All right. What is the debt equity ratio that they have told over there for the other company?
2:3.
Is it 2:3? 1 minute. Beta overall of alpha. So we have to check the equity beta of alpha, not gamma. You take that it's 1:4. 1:4 is the debt equity ratio of alpha. Am I right?
Yeah.
Correct. So with 1:4 means 1 is debt and 4 is equity. Correct?
Yeah.
Correct. So E is how much? 4 divided by E. E is again 4 plus D. D is what? Debt. Debt is 1, but on debt you will have a tax advantage. Correct? Here the tax is 40%. So 0.6 will be your remaining tax. All right. So when you do 4 divided by 4.6, you will get the answer as how much? You will get that into 1.13 is what they have done over here. Are you clear now, Sridevi?
Yes, sir. Yes, sir.
Yeah, perfect. Right. Great. Any other doubts, Sridevi? Do you have any other doubts?
Yes, sir. I wanted to understand minimum variance set.
Okay, that is a very beautiful question. I'll take that question. In
12.
fact, today
Question
only
number
I did
12.
that question in my Kochi classes. Yeah, I'll come down. 1 minute. All right, question number 10. This one, is it? Okay, now tell me. Yes.
Sir, I mean, I want to understand how to solve this question. I'm not having a comfort on this.
You're absolutely clueless about this, but I think we did this in our class, right? This question.
Yes, sir, but I'm not remembering.
I'll quickly explain the concept to you, okay? And I'm going to make a list of some, questions which you are all finding it difficult. So I'll do it on YouTube from next week onwards. One day, one tricky problem, I will put it up, okay? Because
Okay,
maybe everything might not be possible for me to do it in the mentoring program as such. All right.
Okay, sir. Okay.
Fine. Akshaya, Pushpavali, I'll come to your doubt. Let me first explain to Sridevi what we are trying to do over here. Okay. I will just take the screen and 1 minute. All right. So what I'm trying to do, what I'll do here is I'll just explain to you. Basically, they have told that portfolio X and portfolio Y are both falling in a minimum variance set. Yes or no?
Yes, sir.
Okay. So that means if these two are in a minimum variance set, if I somehow copy paste this proportion, okay, if I copy paste this proportion, automatically the new portfolio, whatever is a new portfolio, this also will come under minimum variance set.
Yes.
Okay, because X and Y are already in minimum variance set, so we just want to copy paste the equation. If that is possible, the new portfolio will come under minimum variance set. Now to copy the proportion, ideally we have learned a formula, that is variance of Y minus covariance of XY divided by variance of X plus variance of Y minus 2 covariance XY. Correct?
Yes,
This
sir.
one formula we have learned, but this is only for two securities. All right. Now this one we have to do it for how many securities? Now we have to do it for
Please take care.
3 securities. So that is not possible. That is why we go and use another equation called as the linear equation. So what we do in linear equation is that the linear equation goes like this. We'll put it as weight of B is equal to P plus Q into weight of A. Okay. Now, in this equation, we will take P and Q as your supporting variables. So they are just supporting variables where if I put the values of weight of A and weight of B for portfolio X and portfolio Y, and then when I solve the equation, I will get the value of P and Q. Correct? So that will be the supporting variables. Then I'll take this P and Q and I will put it in the new equation. Okay. So when I put this in the new equation, automatically what will happen is the new equation also will come under what? This will also come under minimum variance set. Are you clear with that part now? So
Yes,
we
sir.
are just, that is why we just take this and then whatever answer we get, we put it in the new. This is the logic behind that question, Sridevi. All
Yes,
right.
sir. Now I
Yeah.
understood.
Now you got the logic. Now try working it out once again. You may not be able to do it or you may be able to do it. What I'll do is I'll anyways mark this as one of the useless questions. Giving a notepad heading over here, useless questions. So this I'll put it in YouTube. So later on also, if anybody wants to grab the logic, it will be easier for you. Minimum variance set. All right. Yes.
Okay, sir.
Fine. I hope
That's
you're
all,
clear
sir.
with this.
Yes, sir. Thank
Any
you.
other doubts, Sridevi? All clear?
All clear, sir. Thank you so much.
Fantastic. Thank you so much, Sridevi. Study well. I'll now take the next doubt. 1 minute. We had a message coming in from 1 minute. I think Pushpavali, right? Pushpavali portfolio question number 31, TYK, page number 6.74. You're talking about the mastery book, right? Okay, let me take the mastery book. Study material, is it? Okay, I'll take the study material. Yours was the same doubt from cleared, is it? Oh, it's cleared now, is it? Fantastic. So I think your doubt is cleared, Pushpavali. Perfect. Akshaya, you want me to explain the last segment of question number 28 of portfolio in the mastery book. 1 minute. Let me open the mastery book first. Portfolio, right? Okay. Okay, 1 minute. Question number, 1 minute. Let me check it again. What is the question number you told me? 1 minute. 38, right, Bushaira? Question number 38. Let me see if I can search like that. Question 38. That must be in the logic booster part. One minute. Question 20. Question 30. 36. This question, is it? 1 minute. With whom am I speaking right now? Bushera, you want this question? Can you please unmute and speak to me, Bushera? YouTube students, I'll come to you also, okay? Dakshin, I'll
Yes,
clear
sir.
your doubt. Just give me some time, okay? Right.
Yes, sir. Yes, sir. This question.
This question, you
38.
have a portfolio value of 170, correct? And
Yes.
cash is there for 30 lakhs. I'll just put it over here. Minute. So you have a portfolio for a value of 170 lakhs. Am I right? Fine.
Yes, sir.
And then you are having cash of how many lakhs over here? You have cash of 30 lakhs.
30.
So what is the total that you get over here now? Do you get the total as 200 lakhs? Correct. They have given you that the portfolio beta is 1.6. So I'll write down over here. The beta for this one is 1.6. What will be the beta of cash? It will be 0.
0.
I can also find out the weights now. I think you will get 85% weight over here and 15% weight over here, correct? So if I put a beta into weight, can you just take a calculator and tell me what is 1.6 into 85%?
1.36.
You get the overall beta in this case as how much? 1.36. All right. Now let's read the next part. Now they say beta of the share is 1.6. After 3 months, the price of the share is dropping by how much percentage? It is falling by 3.2%. Okay, so there are multiple logical ways of doing it. One logical way is, now what will happen? Your portfolio will fall down from 170 lakh by how much? By 3.2%, correct? So what is 170 minus 3.2%? Malini, I'll come to your doubts. Don't worry, we'll take care of that. Okay.
164.56.
Okay. Dakshin, I'll come to you also. 164.
56.
Okay, so this is one method that I'm telling you. Okay, 164. What about your cash value? Will that remain the same?
Yes.
Correct. When you keep it this way, I will assume that the beta remains the same. All right. Now the weights will change. Can you tell me what is the total that you will get over here now? Will it be 194.56 lakhs? Correct. So what is 164.56 divided by 194.56?
84.58.
Do you get the answer as 84.58? Correct. So now what will happen is this one will have whatever weight, even if it's 15.42%. Now we have to do overall beta into weight. So what will be 1.6 into 84.58%?
1.35.
Do you get the answer as 1.35? Is it?
Yes, sir. 1.35.
And this will be 0. So this way, when you do it, you get the beta overall as how much? 1.35. This answer is logically absolutely correct. But
Okay.
there is one more opinion is there. See, I have told you AFM is all about opinions, correct? The other opinion, what they have is that sometimes they take that beta formula number 4. What is formula number 4? Change in portfolio value divided by what? Change in the market. This will also give you the beta. Yes or no? Correct?
Yes.
Now
Yes.
they are saying you that after 3 months, the price of the share is dropping by how much percentage? By 3%. So the change in the portfolio turns out to be how much? It change in the portfolio turns out to be 3.2%. Am I right? And then they have told that the beta of the security is how much? 1.6. Am I right? So ideally, considering this data, we can always assume, okay, I think you'll get the same number. Okay, ignore this. Here, if you do like this, 1.6 is the beta. So if this is falling by 3.2%, the market will fall down by how much percentage? 2%. And you get the answer as same 1.6 only. Ignore this part. This was used in some other question. So I'll just keep it pending. Okay, I'll remove this now. Ignore this part, not required. Okay. Now what are they asking is current portfolio beta. What is the answer that we got over here? Wait. Did we get the answer as 1.36? Can we cross check the solution? Look, they have also got 1.36 over here. Am I right? Correct. Next part, what they have done is they have told that portfolio beta after 3 months, if Mr. X on the current date goes for a long position of 200 lakh on Nifty futures. So everyone look at the board. So now here we are having two markets. One is a spot market and what is the other one?
Future market.
Futures market. Okay. In the spot market, what have I done? I have gone long. Okay. Long. This is actually a futures question. It has come in portfolio. So students who have just done portfolio, don't bother much. It's actually coming under futures also because they have a future part coming in this question. All right. So you are long over here for a value of how many lakhs?
170.
170 lakhs. Now what is this fellow doing? He's going to go long.
Short.
He's going long, not short. In this question, he's going long.
Okay.
Long for a value of how much? 200 lakhs in Nifty futures. In Nifty futures. All right. So what they have done over here is they have used this change in the portfolio formula. So they are saying that 1.6 is the beta. This is nothing but change in the value of portfolio divided by change in the value of the market. So when you put it this way, I think this is what I did earlier, you get the change in the value of market as how much percentage? Do you get the answer as 2%? So now what will happen is when you go long for 200 lakh, this will fall by 2%. If it falls by 2%, the new value will become how much? 196. It is a futures market. Futures market is what? Is it real or is it imaginary?
Imaginary.
Imaginary. But the gain or loss will always be
Real.
So here what has happened? 200 lakh has come down to 196 lakhs. Are you making a gain or are you making a loss? You're making a loss. How much loss are you making? 4 lakh.
4 lakhs.
4 lakh is what, real or imaginary? Real. So your 30 lakh of cash will come down by 4 lakhs. What will be your new cash balance after that?
26.
26 it will become. Are you getting my point? Now what has happened? Your portfolio value over here will be, 1 minute. That's what I did. I think it will be 164.56. 170 lakh minus 3.2. But your cash will not be 30 lakhs. Now what will be your cash balance over here? Cash balance will be 26 lakhs. So based on that, when you do it, you will get a new overall beta. I think when they worked out and they have put again the same formula, change in the value of portfolio is equal to 4.72%. Are you getting my point? With whom am I speaking to? 1 minute.
Yes, sir. Yes. Yes, sir. Now it's clear.
Clear, right? So basically, they have just done it using beta formula number 4. Change in the value of portfolio divided by change in the market. But friends, you have opinion 2 also. You can do it in this method also. Both the methods are logically absolutely correct.
Okay,
Everybody
sir.
clear? Okay, this I have done it in my mastery videos also. I have done this question. Okay.
Thank
So
you,
if you
sir.
have
Thank
that, just go through that once again. So basically, beta formula 4 has been used and they are giving you the answer for this question. Is everybody
Thank you.
clear with this part now? Yeah. Okay.
Thank you, sir.
Thank you so much, Bushera. Thanks a lot. Can I go to the next doubt now? Okay, 1 minute. So Pushpawali, your doubt is cleared. Bushera, your doubt is cleared. Akshaya, last segment of question 28 in the mastery book. Akshaya, did we cover that? No, right? Last segment of question 28 in the mastery book. Is that what we did just now?
38 is what we
This is
did.
38. That is 28, right? Akshaya has asked 28. Let me take 28. Okay. Question 28. Who asked me that question? I'm sorry, I missed out that person. Was it Akshaya? Yeah, that's okay, Akshaya. You can just message me in chat. Absolutely fine. Akshaya, this is a question done using Sharp index model. I have taught this in my class. It is done using Sharp index model. So what will happen in Sharp index model is basically your total variance will be broken up into 2 parts. What are the 2 parts? Non-diversifiable variance and the other one will be diversifiable variance. NDV will be done on an overall basis. Diversifiable variance will be done on an individual basis. Okay. So here the formula will be beta overall into standard deviation of the market into the whole square. This you will take it separately. So it will be diversifiable risk of A into weight of A, the whole square, plus diversifiable risk of B into weight of B, the whole square, so on. And then you will take the total variance. Okay, so Akshay, I have done sharp index model in my class. One question I have done. Do that question, then you work it out. Exactly the same answer you will get. Okay. I think suddenly the problem with this question is when you read through it, you don't. Yeah, tell me.
Sir, usually in the sum, if they say risk, is that means variance or SD, sir? Variance.
So that your textbooks have made a mess of it. When they use the word risk means standard deviation. If they use the word variance means variance. All right.
So okay. Fine. Thank you.
Fantastic. Thank you so much. Thanks a lot. Shall I go to the next doubt now?
Sir, on the same question.
Yeah.
So if in case we are just asked to find out the diversifiable risk, then we will just take up the beta and multiply it by the standard deviation and we'll find it. But in case we are asked to find the random error, that is the unsystematic risk, that case we square up everything and take that as a balancing figure from variance, because unless we square it, we cannot subtract it from the variance. Is that right?
Exactly. The diversifiable, exactly. Correct. Absolutely fine. Correct.
Okay.
Okay, that's because you cannot add or subtract standard deviation. Okay. Right.
Done.
Perfect. Yes. What was the next doubt that we had? Can I take the next one? Okay, wait. So I think, okay, Akshay, your point is clear, I believe. Correct, right? Okay. Next is Arsha. Arsha, your doubt is question number 30, share valuation of the mastery book. Let me take that. You mean dividend policy, right?
Yes, sir. That is the last question, sir.
One moment. Last question, is it?
Hmm.
Thank you for letting me know that. Short selling question, right?
Hmm.
Yeah. Okay. See, basically, this question had come in 2021 RTP. But in the latest study material, this question is not to be seen. That is the reason in my recent classes, I am not doing this in the ODB, in my ODB book. I will do one thing. I'll mark it as one of the, tough questions, which I will do it as a separate playlist in my YouTube. All right. So just give me some time. In 1 week's time, my Kochi classes will be over. Then every day I will upload one tough class or question videos in the YouTube channel. So there I'll fully explain the logic of what is happening over here. It's actually coming under a scheme called as securities lending scheme. Okay. So I will just quickly brief about this now and I will just note it down so that I can do this in the upcoming class. One moment. Okay. I'll mark it over here. Securities lending scheme. All right. Fine. I have put it over here. So I will put a video on YouTube for this. Now I'll just explain the logic to all of you. Just give me a minute. I'll take the other notepad again. Yes. See, what happens in a security lending scheme is, suppose there are two people. The first fellow's name is A. The second fellow's name is B. A is the owner of share. What is A going to do is, A will lend the share to whom? To B. What B will do is, B will enter into short selling. What do you mean by short selling? Means he will sell first and then he will buy later. Okay. So let us say he's lending a shares worth 1 lakh rupees. He will sell the share for 1 lakh rupees. At that point of time, he will get an inflow. Subsequently, he'll buy it back. Let us say at that time, the price becomes 95,000 rupees. What is the gain that he makes over here now? Does he make a gain of 5,000 rupees? Okay. After buying it back, he will give it back to A. Are you clear with this part now? So now what's the profit he made? 5,000. But A is not giving it free of cost. On this, A will charge a lending charge. He will charge a lending charge, which is turning out to be, let us say, 1,000 rupees. So from A's point of view, what is the income that A is getting over here? One, A is getting lending charges. How much is the lending charges he's getting over here? Does he get 1,000 rupees? Correct. Apart from that, he is also entitled to the dividend. So let us say the company is giving a dividend of 500 rupees. Even though the share is sold, A will get the dividend of the share because the shares are given under stock lending scheme. Are you clear now? Okay. Whereas from this B's point of view, his gain will be 5,000 minus he has to pay 1,000 rupees of interest. What is the net profit of A that comes over here? It will be 4,000. This is the logic of stock lending scheme now. Harsha, I think this was your doubt, right?
Yes, sir. Yes, sir.
Yeah. Just put this diagram, or you can just take this later on. It's there in YouTube also. You can take this video later on, but this is how it's done. Based on this, I will solve that whole problem in my YouTube channel and I will share it with you. All right.
Okay, sir. Thank you, sir.
Thank you. Thank you so much.
Sir, I have question number 4 also. I have doubts, sir.
Yeah, sure. Which is question number 4, is it? Same,
Yes.
same chapter, right?
Yes, sir. Same chapter.
I think I came down a bit too much. You're talking about additional practice questions, right?
Yes, sir.
Question number 4. It's a very another tricky question. Yeah, tell me. You want me to explain this whole question?
So that last C point.
Okay, the C point over here is yield on share is calculated at 50% of the profits distributed and 5% of the undistributed profit. So basically what they are doing over here is yield is nothing but investors' expectation, actually. Okay. So they have taken it in two parts. One, they have taken it as 50% of distributed profits. And the other one is what? 5% of what? Of undistributed profit. Of undistributed profit. All right. So now I just take the solution to get the numbers. Otherwise, I will not have the numbers with me. See, what they have done is, so 50% of the distributed profit is the 50% of earnings available to the shareholders. So that was turning out to be 6.4 lakhs. So here they have taken 6.4 lakhs into 50%. How much is 6.4 lakh into 50%? Do you get the answer as 3.2 lakhs over here? Correct. And what about the other one? 5% of the undistributed profit. So that is 5% of the retained earnings, correct? So it will be 5% of, in this example, the retained earnings was how much? 6.208. 6.208. If I'm not wrong, that turns out to be 31,040. Then what they will do is they'll add up these two things together. So what's the total you will get over here? 3.2 plus 31,040 will be 3,51,040.
Yes, sir.
This is actually the profit that they are taking. And then what they do is they divide it with the face value of 80 lakhs. Okay, what is the face value of 80 lakhs? So when you do that, you get the percentage as how much percentage? 4.388%. Or what they're trying to say is that if I invest 100 rupees, I get 4.388% return on the same.
Okay, sir.
This is what they're trying to say over here. Okay. I will add this also to the useless question list. It's a very good question. So I think like this, if I get 4-5 questions per chapter, I can add up all these, videos in the YouTube also. You all can watch it later on also. All right. So I'll just call it as, what is the name? Capital structure, right? Capital structure of Sun Limited. Fine. Okay. Fine.
Thank you, sir.
Yes. Thank you so much, Arsha. Thanks a lot. Shall I go to the next doubt now? I think Arsha's doubt is clarified. Now, Berlin, question number 7, security valuation, mastery book. 1 minute. Question number 7. So, Berlin, you mean dividend policy only, right? This question, right?
Yes, sir.
All right. Can you tell me what exactly is your doubt in this question? This question is a little tricky, but it's a very good question. Logical question. You can do it yourself. But tell me what is
Sir,
your doubt? Yeah.
in the 3 years, the dividend is not being distributed, right, sir? In the 3 years, we are calculating the price of the share.
Okay.
But my question is, why are they taking the dividend amount as 2.5 and not 2? I mean, the dividend becomes 2.5 only at the end. After 3 years, right? Year 4.
Correct.
That is my first question. And my second is, they're not considering growth in that.
Let me check. I'll tell you. Okay, wait.
Nice.
So let's read the question. There is a P0. How much is a dividend paid just now is how much? 2 rupees per share. Correct? I'll write down D0 is equal to 2 rupees per share. And it's expected to grow at the rate of how much percentage? The growth is how much percentage over here? 6% is the growth. The board declared to take up the project by retaining next 3 annual dividends. So next 3 dividends, they will not pay. It will be retained. Okay. Then it is expected that the project is of the same risk as the existing project. The result of this project will start coming from the 4th year onwards. So result comes from 4th year onwards. That's why they would have taken 2.5. Let me anyways go through the remaining part. The dividends will then be 2.5. So D3 will be how much? Sorry, D4 will be how much? 2.5 rupees per share. Plus, what is going to be the growth over here? 7% per annum will be the growth from there onwards. All right. So, friends, value of a share is nothing but present value of future cash flow. So, they have taken 2.5 divided by 8 minus 7 will give you the price at the end of year 4, is it? Or is it year 3? I think it is year 3. There's a correction over here. Berlin, thank you for letting me know that. I'll mark it. Okay, 1 minute. This is P3 into 1 divided by 1.08 ratio 3 is actually giving you P0. So directly you can write down P0 over here.
Yes, sir.
This is P0. This is also P0. Okay. I have noted down the correction. I will change it in the mastery book. All right. Yes. Tell me, what is the other doubt that you had?
So scroll down a little bit, please.
Yeah.
Here they're calculating the price of the share for the 3 years in which the dividend is not being distributed. So why are they taking the dividend amount as 2.5, sir? I mean, the dividend remains at 2 rupees like for the 3 years, right? Only after 3 years the growth is, I mean, the dividend becomes 2.5.
Annual receipt of 2,000. In order to maintain his receipt of 2,000 for the first 3 years, he would sell the share at the end of each year. The expected price at the end of the share of each year is calculated below. Okay. So the market price at the end of 3rd year will be, this is done correctly only. At the end of 3rd year, how do you work out this 2.5? It will be D4 divided by KE minus G, correct? So your price at the end of the 3rd year, P3 will be how much? It will be 250. This will be what? This, whatever answer you got, again you're dividing it by 1.8 to get the price at the end of year 2. This is done to get the price at the end of year 1. Are you getting my point? After we get the
taking it as
yeah. Come again, Berlin.
So taking it as P3 is equal to D4, the same formula, and they just discounting it down.
Exactly. Yes. And then they're just bringing it to the present value over here. Got it? So after you get this, then what they want to get a money of 2,000 every year. So what he will do in the first year to get 2,000, he will have to sell how many shares? 10 shares. Second year, he will have to sell only 9 shares. Third year, he will have to sell how many shares? 8 shares. So now 10 plus 9 plus 8, if you do, 19, 27 shares are gone. Correct? All right. So 27 shares are gone. So at the end of the 3rd year, after you sell 27 shares, how many shares are remaining with you? Only 973 shares are remaining with you. Are you clear? Okay. These 973 shares are valued at how much rupees? 250 rupees. So at that time, you'll get 2,43,000. Are you clear now, Berlin?
Yes, sir. Clear. Thank you.
All right. Now you can work it out. Okay. These are all very, very good questions. I'm happy that all these questions are coming up as doubts. Yes. So Berlin, your doubt is also clarified. Akshay, your doubt is also clarified. In YouTube, I had a doubt from Dakshin. Yeah. Dakshin, sir, options, question number 8 in the ODB. Dakshin, are you there? Just type a hi in the chat box. Are you there in YouTube or are you there in Zoom? I think you're there in Zoom also, right? Yes. Hi, Dakshin. Can you please unmute and speak to me? I'll take the ODB book. You want me to take options, right? Yes. You want ODB, not mastery, correct? Question number, sorry, options. Yes, you wanted question number 2 and 3, is it? Okay. Okay, tell me, Dakshin, what is your doubt in question number 2? Is it possible for you to unmute and speak to me, Dakshin?
Sir, 8th one, sir.
8th one, is it?
Yes, sir.
Ah, this question. Okay, Dayal. Okay, tell me.
Sir, this I am not able to understand, sir.
Okay, this is a very, very tricky problem. I'll just quickly explain to you now, and then I will take a video of this separately and I'll upload it to the YouTube channel. Will that be okay? Okay. So here,
Okay.
what we are doing in this question number 8 is that first part, we'll just take the numbers. What is the spot price that is told over here? Is it 600? 600. The price can either go up to 780 or the price can fall down to how much? 480. Am I right? Okay. So with this data, we can actually find out the value using binomial model. What is the binomial model formula? Cu into I minus D divided by U minus D plus CD into U minus I divided by U minus D whole divided by I. So here Cu will be how much? It will be the price when it goes up. So the exercise price is how much? 630. So do you get the answer as 150? When it goes down, what will you do? You will lapse it. So the formula will be 150 into I. What is the I that you have over here? I think the interest rate is turning out to be 1 minute, 10%. So into 1.10 minus D will be the downside price. That is 480 divided by 600 whole divided by 780 divided by 600 minus 480 divided by 600 plus CD will become 0 whole divided by 1.1. When you do like this, you will get the answer as 65.85. This is the beginning part. Okay. So I'm talking to Dakshin, right? Dakshin, this part is clear to you?
Okay, sir.
This is a basic binomial model that we have done. Correct. Now the problem what is coming in this case is that after we work out this first part, they are asking you to create a perfect hedging. Okay. So in order to create a perfect hedge, we will have to use a formula. That formula is new. The formula goes like this. For perfect hedging, the formula will be C1 minus C2 minus divided by S1 minus S2. So basically that's nothing but change in option value divided by what? Change in the spot price. Okay. So what is the change in the option that we have got over here? 150 minus 0 divided by what is the change in the spot? 780 minus 480. So you get the answer as 150 divided by 300. You will get the answer as how much? 0.5. Or the logic of this 0.5 is that for every one share that you sold, sorry, for every one option sold, for every one call option sold, you should buy how many shares? 0.50 shares is what you should buy back. All right. So this is a hedging technique because we have learned that change in X divided by change in market will give you the beta. So here change in option divided by change in spot is giving you an approximate form of a beta only over here. Are you clear now? Okay. So once you get this answer of 0.5 over here, we will go to the next part. Okay. And I'll just show it to you how this actually works. There can be two situations that can happen in the stock market. One, the price can fall down or the price can go up. The price can fall down to 480 or the price can go up to how much? 780, correct? If the price is falling down to 480, you are doing what? You are buying 0.5 shares. And you're doing what? You're selling one call over here, correct? So when you buy 0.5 shares, 480 is the price. So your 0.5 shares value will fall down to how much? 240. Now you have sold a call. What do you mean by selling a call? A person who sells the letter so that the other fellow can buy the share at 630. Other fellow can buy the share at 630. Outside market is 480. The other fellow will do what? He will lapse the call option. So the net cash flow over here turns out to be how much? 240. Now let us say the price is going up to 780. Again, you have done two actions. One, you have done buy 0.5 shares. Two, what have you done? You have sold one call. Am I right? So when you buy 0.5 shares, the value will turn out to be how much now? 390 rupees. That is 780 into 0.5. Now when you sell a call, the buyer has a right to buy at 680. Outside market 780. So what will the buyer do? The buyer will exercise and his profit will be 780 minus 630. That is equal to how much? 150 rupees is going to be the buyer's profit. So for me, it will be a loss. Now when I take 390 minus 150, again, I will get the answer as how much? Correctly, I'll get the answer as 240. Or when the price came down to 480, I got 240. When the price went up to 780 also, I got 240. Hence, I can say that I have actually created a perfect hedge. Dakshin, are you clear now?
Yes, sir.
So far clear, right? After this, they have asked you one more question where they're asking you, what is the value of the option today? Okay. So to get the value of the option today, what we will do is, now we will do it from the buyer's point of view. Or sorry, not the buyer's point of view. We are talking about the value of combination option. Value of combination option. So when I say combination option, there are two steps over here. One, you're buying a share, correct? So when you buy a share, you're paying how much money over there? 300. Then what are you doing? You are selling a call. So when you sell a call, you will receive a premium. Am I right? So the net effect of this will be minus 300 plus P, correct? Now, on this, you are expecting an ROI of how much percentage? 10% is for 1 year. So when I do into 3 by 12, how much will I get for the third 3 months? Will I get the return as 2.5%? Now, at the end of 3 months, wherever the price goes, I will make only 240 rupees. We just saw that in the previous page. Even if it goes up or comes down, the price will remain at 240. Everyone clear? So now I can form an equation. The equation will be 240 rupees is the value today. This is nothing but 300 is the cost minus P into 1.025. So when you solve it, you get the value of P as 65.85. Coincidentally, this number is exactly similar to the value you got under binomial model in the first page. Are you getting my point? So once you get this, then they're asking you to calculate the ROI. ROI means as a buyer, you will have to pay how much money today? You will have to pay 65.85 today. At the end of 1 year, the price may go up or the price may fall down. If the price goes up, you get 150. If the price falls down, you will lapse. So 150 was having a 60% probability if I'm not wrong. So do you get the answer as 90 over here? So in that case, what is the profit that you will make over here now? You'll make a profit of 24.15, correct? So now if you're making a profit of 24.15, your ROI will be 24.15 divided by 65.85. That will be 35 something percentage. With that, this question actually gets over. Okay, so actually I put this in YouTube also. You can replay the whole video. It's a little complicated question. I will anyways elaborately solve it once again in YouTube as a separate tough question. All right.
Okay,
Just be in
sir.
touch in my YouTube, subscribe to my channel. You will get all these videos at that point of time. Okay.
Okay, sir.
Perfect. Perfect.
Sir, in this question, the value of combination option should be only found out using this method, or we can use any of the binomial method also, sir. Because
No,
you said this
you
question
cannot.
matching is
Yeah. Tell me. So,
because you said it is coincidentally matching with the 65.85.
that is a
Is it
coincidence,
only
what I believe. Until we do it in 2, 3 other combinations and get the same answer, I suggest we stick to the proper method only. Because one more thing, Vishnu,
okay?
exam, the steps also carries a lot of marks, correct?
Yes, yes, sir.
It's better to stick to this method only. Okay.
Sure.
Okay. Thank you. Thank you so much, Vishnu. Yes. I think that part is clear. And I think all the doubts are clear. Shivani. Okay, Shivani, you want me to explain to you how I got that 3% continuous compounding, is it? Shivani, for continuous compounding, CCF, the formula is 1 plus R square divided by 2. So here that was 12% was the question that I shared in the group. Into 3 by 12 will give you how much percentage? It will give you 3%. So the equation will be 1.03 plus 0.03 square divided by 2. So you'll get the answer as 1.03045. Okay. Mega Mastery Book Futures. Okay, yeah. Mega, those two questions, just keep it pending for time being. Basically, what has happened is in the Mastery Book Futures, I have added the RTP questions, which is not there in the study material. So they are two little tricky problems which came in one of the earlier RTPs. So I think that is where Mega, you got a bit confused, and I think we spoke over messaging also, right? One moment. Let me take futures. Yes. Okay, this is the chapter. I'll just take those questions and I'll just try decoding it. They have asked some unnecessary areas like, what are the charges of backwardation or contango charges, etc., etc. I'll just go through it once again, Mega. I couldn't go through it earlier, but I'll definitely go through it and I'll add it to the special questions that has to be done in the YouTube session. All right. So that everyone can, have that exposure. 1 minute. I think it was question number 1 was okay, right, Mega? 1 was comfortable, and these are all easy. Not these. These are all easy questions. I think the additional practice question is what you must be talking about, correct? Yes. Mega, this question 2 is easy. You must be speaking about question number 3, right? 2 is very easy. 2 we have done in class also. Three is a question which I need to work out. They have given you they have sold 4 months Nifty futures for 9 lakh. At the time of closing, the index turned out to be 2,100. Multiplier is 75. The price of one future contract, Nifty Sensex, for the theoretical value to be correct. This question, you give me some time. I also need to work it out. With logic, I will explain it to you. Mega, hold on. Question number 2. Mega, can you unmute and speak to me?
Hi, sir.
Hi, Mega. How are you doing? Yes.
I'm good, sir.
Yeah, Mega, this question number 2, we have done it in our class, ODB book. You were a regular student, right?
It's May 24, sir.
Yeah, May 24. In that ODB book, this is done in Forex chapter. You've covered Forex, right?
Yes, sir.
In Forex, before we did futures, we have done this question. This is a very, very easy problem. If you are not able to do this question, means you're lost out somewhere on the conceptual part.
Maybe I'll try once more, sir. And if I don't get it, I'll let you know next
Yes,
Monday.
this is a very easy question. What you do is, 1 minute, Mega, let me just clarify. Have you completed doing your Forex revision?
No, sir.
No, right? In Forex revision, you just take the concept of forward contract. Okay?
Okay.
Forward contract, I have taught you about the 3 steps in case of forward receivable. Sell forward, buy forward, sell spot.
Okay.
Okay? That same step along with number of contracts is what comes into future. Okay? So do that first and then you do this question. Question 2 is very easy. 3, I can agree that there is some additional adjustments are there which are actually not very logical also. And it came once in RTP November 2020, not repeated after that. So important wise, I wouldn't give it much importance also, but this question is very, very easy. Question number 2. Just try it once, and if you still don't get it, get in touch with me. All right?
Oh, okay, sir.
Let me check question number 4 now. 4 is also very easy. 4 is also very easy. Only that question number 2 has a little bit of a tricky adjustment. Next Monday, I will sort it for you. I didn't get time to go through that adjustment. So I'll go through it and I'll get back to you for sure. All right?
Okay, sir. Thank you.
Thank you. Thank you so much.
Sir,
Yeah,
hello.
tell me. Tell me.
Sir, in ODB book, the first 2 questions don't have the answers, sir.
Yeah, that I'm updating it. By tomorrow, I'll update the answers and I'll upload it over there. All right? It will be done by tomorrow.
Yeah.
For sure.
Yeah, I
Okay.
even messaged you, sir. Venkat. Thank you.
Yes, Venkat. I have talked to my team. They are working on it. By tomorrow, we'll upload the ODB book questions with the solutions also. Okay.
Yeah. Oh,
Fine.
thank you, sir.
Thank you. Thank you so much. Thanks a lot. So, friends, I believe
Sir,
all the questions clarified. Yeah, tell me.
interest rate derivatives. So interest rates derivatives.
Yeah.
Question number 5 of ODB. Sir.
ODB, right? 1 minute.
Yes, sir. So you crossed it.
Yeah, drill dip, right?
Before. Yes, sir.
Okay. Yeah. You want you mean the solution is not there? Is that what you meant?
No, sir. I also need a brief explanation for this question.
Okay, fine. I'll explain this to you. See, what is happening is, I think
Yes,
we
sir.
did in the class also, right, Vishnu? No?
Yes, sir.
But I'll re-explain the whole thing. Just give me a minute. Basically,
Yes,
what is happening is, drill dip is in US.
Okay, sir.
And then there is some Indian fellow who's staying in India. This is India's bank. This is the US bank. All right. So drill dip has already taken a loan of 10 crore over here, on which he is already paying $8 crore as an interest. This money, he wants to bring it to India by converting at a spot rate of 50 rupees so that he can invest 500 crore in the Indian project. This Indian project will give 740 crore after 1 year. So he's going to make a profit of 240 crore over here. All right, fine. So this 240 crore of profit, what he makes over here, he has 2 options available with him. Option number 1, what he has is he can enter into a swap. Option number 2, what he has with him is don't swap. These are the 2 permutation combinations that is available with him. Are you clear so far, Vishnu? Yeah.
Yes, sir.
Now, what happens is when you are not doing a swap, so when you don't swap, what happens is you get the entire 740 crore in your hands. You convert this at 54 rupees per dollar. Can you tell me what is 740 divided by 54 rupees per dollar?
13.70.
So you get 13.70 crore dollar. Minus, you already have to pay a loan of 10.8 crore dollar over here, correct? So what will be your profit?
Yes,
Your profit will be 2.9 crore dollar. But you have one more option. You can enter into a swap. The moment you enter into a swap, drill dip will become liable to pay only the US loan. Sorry, he will be liable to pay the rupee loan. Correct. So now what will happen is, the moment he gets 740 crore, he will repay the rupee loan of 500 crore and balance 240 crore only he will bring it back to USA. So what is 240 divided by 54?
4.44.
So he'll get 4.44 crore dollar minus he has already paid interest of 0.8 crore dollar to his own bank. So once you reduce this, you will get a profit of how much? 3.64 crore dollar. So which is better?
So doing swap is better.
Better, exactly.
Okay.
All right, Vishnu?
Thank you. Thank you, sir.
Thank you. Thank you so much. Yes, friends. Any other doubts you have?
Sir, classes uploaded, sir.
Yeah, tomorrow by evening, all the classes will be uploaded. The course has been created. We'll upload all the classes by tomorrow and then a coupon code will be given to all the Chennai students. All right?
Sir, not that one. Already you completed this one.
Regular batch, is it? That will be done today night.
Yes, sir.
After this, I'll do it. Okay?
Oh, okay, sir. Thank you, sir.
Thank you. Yes, friends. Malini, you had some doubt, right? I read somewhere, I don't remember where I read it. Malini, is it sorted out? Yeah. All right. Fine, friends. So I think all the doubts are clarified. Yes.
Sir,
Yeah. Tell me.
my doubt.
Yeah.
I'm having doubt on futures.
Yes, Malini. Where did you have a doubt? Can you let me know?
The in mastery book, question number 19.
Which chapter?
So futures.
Okay. Okay. Futures. Additional questions, right?
Yeah. The last page.
Okay. In this last page, is it? Okay. Okay. This one, is it?
Yeah, yes, sir.
Okay. So here basically the company's name is ML. You have 1000 shares, beta value 1.25, purchase price is turning out to be 700. He wants to hold the investment till the end of September with an expectation of huge dividends to be announced in the AGM. On the date of investment, the Nifty futures is having a quotation of 1,75,000. Lot size is 50. Okay. Advise how to hedge his market exposure using the available data. So 1 minute, he wants to do a perfect hedging. We have learned about perfect hedging, right? So that will be.
Yes, sir. Sir, I have only one doubt, sir. In that, the working note part 3, actually the market is actually fall down by 5%.
Okay.
But here the means here they means calculators gain on stock. Actually, it's a loss, right?
Okay, wait, let me just check. ML is fallen by 5%, is it? 1 minute. ML has fallen by, wait a second. ML Limited falls by 5%. So here this falls by 5. So 1 minute. Okay. That's a typing error. Okay, it's supposed to be loss over here. Thank you for letting me know about that. This is loss.
Yes. Yeah.
Right. Fine.
Okay.
Of this.
Yes, sir. One more doubt, sir.
Yeah. 1 minute. I'll just take an image of this and send it to my team so that this can be corrected right away now. Done. Yeah, tell me.
So question number 14.
Same chapter, right?
Yeah, same chapter.
Okay. Yeah. Okay.
Can you explain me that question just brief?
Overall, right? I'll explain to you. This is a very simple question. Now, Malini, I'll just explain to you. Ram is buying 10,000 shares of X. So you are having one, you have X limited. Here you have done a buy of how many shares? 10,000 shares of buy at the rate of how much? At the rate of 22, correct? Whose beta value is how much? 1.5. Beta value is 1.5 and sells 5,000 shares of A limited. So you have one more share over here, A limited, for which you're selling how many shares? 5,000 shares at a price of how much? At a price of 40 rupees per share. All right. Having a beta of how much? Having a beta of 2. Am I right? Now, he obtains a complete hedge by Nifty futures at 1,000 rupees. So basically, when you check about this will be 2,20,000, correct?
Yeah.
Okay, this will be, I think, nothing. This will be 2 lakh. Correct. So now, if you want to take a Nifty, you'll have to take the opposite position. Here it is buy. So what will you have to do? Sell Nifty future for a value of S0 into beta. That will be 3,30,000. Correct. Here, what is happening? You have done a sell. So what will you take? You will do a buy Nifty future. Correct.
Yeah. Yes.
That will do it for a value of how much? 4 lakhs. So instead of doing it two separately, you take it as a net effect and you will do a buy for how much? You'll do a buy for 70,000 Nifty future.
Okay.
Are you getting my point?
Yes,
okay?
sir. Yes, sir.
So once you do this, then they're asking you, next day, X is falling by 2%. So this is going to fall by how much? Fall by 2%. And I think A is going to go up by 3%, plus 3% over here. All right. And Nifty is going to be dropped by 1.5. This is going to fall by 1.5%. So just do 2 lakh into 2% will be your loss. That will be, I think, 4,400, if I'm not wrong. Yes, 0.98. So they are basically putting all these things and then they're getting a gain or loss. You get a loss of 11,450. How you get this, I'll explain to you. If you have a calculator, please help me out. 2,20,000 into 2% is how much?
That's 4,40,000. It's
4,400.
2%. Yeah.
4,400. Correct?
2,20,000. Yeah.
That's only 2%. Now, how much is 2 lakh into 3%? That's a gain of 6,000.
6,000.
All right. Now, what is 70,000 into 1.5%? I think that's a loss of 1,050.
Yeah.
Am I right?
1,050.
So sorry. This is also a loss. Why? Because you have, sold it and the price went up. Understood? So total will be 10,400, 11,450 will be your total loss.
Loss.
Clear?
Okay. Okay, sir.
Thank
I
you.
will check on that, sir. Thank you.
Just check
Thanks,
it
sir.
out. Okay.
Yeah.
Thank you. Thank you so much. So I believe all your doubts are clarified. YouTube students, I
Sure.
hope doubts are also. Yeah, tell me. Yeah.
So in the question number 31 in the portfolio management.
Okay. Question number in mastery or ODB?
Mastery book, sir.
1 minute. Mastery book portfolio, right?
Portfolio management.
Okay. Question number
31.
31. Okay. Yeah.
Somebody please explain the second part of this question.
Yeah. This question, second part, they're asking you to find out the cost of capital. Correct. So cost of capital is KO. How do you find out KO? RF
KD plus
beta overall into RM minus RF. KE is RF plus beta equity into RM minus RF. Am I right?
Yes, sir.
Like that, KO will be what? RF plus beta overall. So when you come down here, what they have done is they have taken the beta of debt is not given. It is assumed to be riskless. So we take it as 0. All right. So now they have found out the overall beta as 0.9. The second part, they have taken RF plus beta A. A is nothing but beta overall into RM minus RF. That's how they got the answer as 17% over here.
Okay, sir.
Just work it out based on this now. I think that CAPM formula is where you would have got confused. Requirement 2 is your doubt, right? Not requirement 3, correct? Wait. A discount rate for an expansion of present business. 1 minute. Computation of asset beta. You have overall into E divided by E plus D. Okay. Computation of cost of equity and overall cost of capital. That part I explained. If fund expansions are raised in the same proportion as existing capital structure, alternatively, they have used cost of equity, KE. If the funds are raised in the equity, then it is KE. If the funds are raised overall, it is KO. So when you do KO, what will you take? You will take the beta overall in that case. Are you clear now, Christine?
Clear, sir. Clear, sir.
All right.
Thank you, sir.
Thank you so much.
Sir,
Yes, Indra, tell me.
sir, question number 28 of portfolio management mastery book, sir.
Yeah, this is mastery book only. Question number 28, is it? 1 minute.
Yes, sir. Could you please explain its working, sir?
1 minute. Question 28, is it? Okay, wait,
Yes, sir.
This question, I will have to draw the chart. This is what I just explained a little bit earlier. We are breaking it up into 2 parts, okay? One, we take it as diversifiable risk. This is all diversifiable risk. This is all done on an individual basis.
Okay, sir.
Whereas non-diversifiable risk is done on an overall basis. So if you check the NDV, somewhere you would have found the NDV also. That will be, okay, wait, how do I do it? They have solved it with a lot of mathematical numbers. I'll do one thing. Wait. It is given. Beta is given. Okay, I'll just draw a chart and show it to you. 1 minute.
Okay.
So when you do a total variance consists of 2 parts. One, it consists of NDV, non-diversifiable variance. Then it consists of diversifiable variance. NDV is done on an overall basis, whereas diversifiable variance is done on an individual basis. Am I right? So here the formula will be beta overall into standard deviation of the market, the whole square. So how much is the beta overall? We need to find out. That is 1.6 into 0.25. I think it's done somewhere down.
Yes, sir. It is 1.295.
So here the formula would be 1.295 into what is the standard deviation of the market? 18. Into 18 the whole square. Okay. Whereas this individually, what you will do is we have the risk given over here, right? So the formula will be 7 into 0.25 the whole square plus what is the second one? 11 into 0.3 the whole square plus what is the third one?
3 into 0.25.
25 the whole square plus what is the last one?
9 into 0.2.
0.2 the whole square. After that, you take up all this, you will get the total diversifiable variance. Here you get the total non-diversifiable variance. You add up these two, you will get the correct answer. Okay.
Okay, sir. Sir, according, then the next page, they have given a computation, right?
Yeah, this is nothing but I think the same thing that we did. Why? What is this 1.6? Where did you get that?
1.6 is the
Beta.
beta.
Into 18 square plus what is 72?
Yes, sir. That's what I don't understand. Madam.
You just solve it in my style, Sumati, and get back to me. Can you WhatsApp me after that? So I'll change the solution over here also. Okay.
Okay, sir. Okay,
I
sir.
think
Sure,
you would
sir.
have done it as per the textbook methodology. That's why it's come like this. I think plus 72 would be. Can you tell me what's the square root of 72 by any chance?
72. It is 8.48.
I don't know how they have got that number. You just solve it like this. You'll get the first you do it and tell me what answer you get. Then I will change the answer over here. All right. So I'll mark it. 20 portfolio. 1 minute. 1 minute. Question 28 portfolio. 1 minute. Question 28 portfolio. Okay. Yeah. Tell me.
Sir, and then in dividend policy and share valuation mastery book,
Okay.
question number 25, sir.
1 minute. I'll take that. You mean dividend policy, right?
Yes, sir. And
question number 25, correct?
yes, sir. It's page 368, sir.
That's okay. Let me just take this. 368 is it? 1 minute.
Yes, sir.
368. Sorry, it's not there. Question number?
25, sir.
Yeah, this is the one we discussed. Okay, tell me. Yeah.
Yes, sir. Actually, in this RF is 9%, sir. They have taken growth rate 7% in all the formulas, sir. So the answer differs.
Oh, there's a correct typing error over there, is it?
Yes, sir.
Okay, 1 minute. Let me mark it down. Okay. RF is 7%. Okay. Sorry. RF is how much? 9%. Wrongly taken as 7%.
7.
Okay. I will rework this question. What is the page number that it is coming on? 4.111, right?
4. Yes, sir.
1 moment. Fine. Okay. I have marked it. All right.
Okay. Thank you, sir.
Thank you. Thank you so much. Yes, friends. Any other doubts pending to be done? I believe all the doubts are clarified, friends. Perfect. So, friends, I think we are done with today's session also. Hold on, Dakshin. In interest rate derivatives, Institute study material question is not displaying in that folder. Which question, Dakshin? I didn't follow your doubt.
Sir, that study materials question, sir.
Okay. That is not, that you're not able to see that in my material is what you're trying to tell me, is it?
Yes, sir.
No, all the questions are fully covered. 1 minute, I'll show you. Which question are you talking about?
Sir, in your app, sir.
In my app, it is not seen, is it? 1 minute.
Yes,
IRRM. It's there over here.
Sir, not in that, sir. 1 minute, sir. I will check in my app, sir.
Yeah. Everything is available here, okay? Full thing is there, all right?
Sir, in that, I go AFM study material questions in batches, sir.
But why are you going to that batch? I have already given you mentoring batch access, right?
Oh, okay, sir. No,
Okay.
sir, if I have some doubt, I'll be going there, sir.
Yeah. There, I don't think that's relevant anymore. That was done long back. Okay.
Oh, okay, sir.
Fine. So, friends, I believe you're all done with this part. Yes. So, shall we wrap up our session with this now? All right. Keep studying like this, friends. Keep coming live every Monday. We'll consistently study together. We will win together. All right. So, this week, completely focus on futures, options, and interest rate derivatives. Thank you so much, everyone. Study well. I will see you next Monday. Take care. Good night, everyone.
Good night,
Thank
sir.
you.
Thank you, sir. Good night.
Thank you, sir.
Thank you.